today, or indeed from the situation in any particular country. Let's ask ourselves the key question. What is finance for? We all know what labour is, or joiner is, or travel agents is. They clearly make something we need and they do something we want. Finance doesn't. Finance facilitates other forms of economic activity. Now, it's true that in recent years, and particularly, I think, in the US and the UK, in the so-called Anglo-Saxon world, finance has taken on a life of its own, starting to fabricate products, complex products, that have absolutely nothing to do with the broader economy. It's an old joke, and I think it's true. If the answer is a CDO squared, then we're asking the wrong question. Even more esoteric, a quantum swap, a swap on the direction of completely unrelated exchange rate. There is no rational reason, no rational economic reason for products like that. In my opinion, banking, finance more generally have more in common with utilities, like electricity and water, than they do with, say, fishing or butchery. They're a different kind of animal. Let's bear that in mind, and let's try to keep finance in perspective. That said, banking is in one important way special. Indeed, in one important way unique. It deals with money. And that tends to give bankers, people like you, ideas above your station. Hilton's first law of finance explains why. It says that a very small percentage of a very, very large number is still a large number. And that's important. In other words, the sums of money sloshing through the financial markets, even in Nigeria, are enormous. And a fair amount sticks to the fingers of those who dabble in them, which gives you an inflated view of your own importance. It also tends to set you apart from the rest of society. You're richer, even if you're not necessarily wiser. This applies to bankers in England, it applies to bankers in Germany, in the United States, wherever. And it also sets you against your regulators, who I assume, and I assume this is true in Nigeria as it is everywhere else, are probably not as well paid as you are, not as rich as you are, unless of course you're related to the Emir of Kano, and probably don't work as hard as you and want to have a life of weekends. So there's a mismatch between the bankers on the one hand and the regulators who are supposed to supervise them. But put yourself in the shoes of your regulators for the moment. In the post-crisis world after 2007, 2008, regulators and the governments for whom they work have had a relatively simple choice. Choice one, they can tighten up financial regulation. Choice two, they can restructure the financial services industry in such a way that they don't need to regulate it so tightly. Now, so far, for better or worse, all the evidence is that the regulators are, as one would expect, opting for the first alternative, to regulate more. And the reason is simple. Regulators regulate. That is what they do. Regulators regulate, supervisors supervise. Even Governor Sanusi is not going to put himself out of a job by reforming the banking industry so that it doesn't need so much regulation. As a result, there's less and less focus on structural change, despite the fact that there are many influential advocates of structural reform in Europe and in North America. Among these, clearly, Saint Paul Volcker stands out, though his proposals are hardly radical or he's certainly not alone in arguing for some degree of structural reform. As was pointed out, we published a report a couple of years ago called Grumpy Old Bankers, where we got very grumpy old bankers, some of them very old as well, very grumpy, very old bankers from both North America and Europe to write about the crisis. And many of them, in fact, I think the majority of them said the mistake is that we let banks get too big. The secondary mistake was that we let them get too complex. What we need is more banks, smaller banks, and simpler banks. And it's also the case in Europe that there are people who argue along the same lines. There was a committee headed up by every leader, a Finnish politician, in the EU, which came up with a very similar answer. In the UK, there was a commission headed by John Vickers, which urged that a ring fence be put around retail banking to stop high-risk proprietary trading with the benefit of an implicit or explicit government guarantee. So at least there are moves along those lines. And I think that even in my little think tank, we put out a paper by a very well-known British economist, Professor John Kay, which got a lot of publicity for us at the time, where he advocated what he called narrow banking, keeping the activities that banks could do within a very narrow course. In the US, there are many old bankers, John Reed from Citigroup, Henry Kaufman from Solomon, who are even more vocal in support of breaking up the banks, and indeed in reimposing the old Glass-Steagall rule that Mr. Volcker was, and they do have some influence. So some of this is going to happen. The Volcker rule, for instance, is being written into the Dodd-Frank rule book, although very reluctantly. And as I say, ring fencing is supposed to be part of the UK's financial reforms. Indeed, it's already written into the primary legislation, which is due to be implemented in 2016, though there's still a big fight about what's going to be inside the ring fence and what's going to be outside. And that fight is important, at least for the banks themselves. Will the simpler government guaranteed retail bank be permitted to offer its smaller corporate clients a full range of financial services, including, for instance, swaps and options, or will those smaller firms have to look elsewhere for anything more sophisticated than a current account and a bit of trade finance? I'm not heartbroken on this either way. I listened to bankers, senior bankers in big institutions like HSBC or Standard Chartered, and they argue that they have to. They are absolutely bound to offer a full service to all of their clients around the world. And I know, I asked them, where do you buy your suits? You're a full-service banker, you have to be a global banker, you have to be in 140 countries around the world. I assume, therefore, you buy your suits at Walmart. No, they don't. They buy their suits from some tiny little Jewish tailor on Savile Row, and they pay either £3,000 or £4,000 for it. There is a room for a niche product. There is a room for specialization. Whatever happens, it will only be structural change at the margins. The Dodd-Frank rule book, for instance, now runs to several thousand pages, and very few of them have anything whatsoever to do with the Volcker rule. Instead, I think that regulators are now pinning their hopes on the new and much more complex capital rules which are enshrined in Basel III, or as we know it now in Europe, CRD Capital Requirements Directive 4, CRD4. That's even though many of those same banks haven't yet even thought about implementing Basel II. There's a sort of ineluctable escalation of regulation. We have abandoned the idea of light touch regulation. We have abandoned the idea of principles-based regulation. Instead, we're now in the process of imposing a much more onerous, a much more complex capital regime. A basic requirement of which is that all significant banks have a core tier 1 capital ratio of at least 8% of risk-weighted assets. You all know that. We're coupling that with a significant toughening up of what constitutes capital and a much more rigorous and complex assessment of risk-weighted assets. What we haven't got away from is the reliance on complex internal models, even though it was those very same models like VAR, that got us into trouble in the first place. We haven't learned. Plus, there's a bit of national wiggle room, which undermines the idea of international uniformity, which means that in the UK in particular, the regulator will effectively demand a good deal more than a tier 1 capital level of 8%, maybe almost twice that. And then, of course, there's the new regulatory backup capital isn't enough, just in case that complexity, all that complexity doesn't work. We will also have a much cruder liquidity buffer, a requirement that every bank, be a going concern, even if it is excluded from the short-term money markets for at least 30 or perhaps more days, just in case the banks are minded to gain the new Basel rules, which of course they will do, because as I pointed out, generally bankers, you lot, are better paid and harder working than regulators that lot. And they're also incentivized to find complex ways around complex rules. That's the key to me. The more narrowly prescriptive the regulatory rules are, the harder the banks will work to circumvent them. I'm sure that's true in Nigeria, just as it's true around the world. I'm reminded of the congressional testimony of J.B. Diamond, the boss of J.P. Morgan, that he gave only a couple of months ago, with any particular regret. To him, it was just the cost of doing business as a small beer. But J.P. Morgan's experience is generalized. 301,000 employees. Okay, so we're going to have a person supervisor working full time on you, be scared, be real scared. Those who are to dig the HSBC, it's true of any big bank, it's also true at a national level. I'm sure it's the response of many of you when your regulator comes forward. If you're big enough to hire a lawyer, they're engaged in a sort of global arms race. Nationally, in the UK, the FSA was tied enough, but now we have two separate powerful regulators, the PRA, the Bank of England, and the Financial Conduct Authority. Two sets of supervisors, often working across purposes, often demanding the same sort of data, just with different tweaks. Europe, we have the European Central Bank and its new baby, the single supervisory mechanism, SSM. It's clearing the way to take over supervision of the 130 or so big banks in the Eurozone. At a more global level, the Basel, IOSCO, and all the other regulatory bodies to which we have to make obeisance. There are no winners in this. There are no winners in this never-ending expansion of regulations and economic growth. And to add insult to injury, you'll probably force them to take on even more risk, a row of bricks in the wall that keeps out competition. So, in my mind, what we have today is a situation around the world where banking is becoming essentially a protected industry. It still pays pretty well because it deals with money and because it's a small percentage of a large number, it's still a large number. But it's going to be less and less efficient at delivering the economic growth that society wants it to deliver. And in a country like Nigeria, which needs economic growth of 6% or 7% to generate the jobs which its young people demand, I think that's really important. So, to quote my old friend Vladimir Lenin, what is to be done? I mentioned at the very beginning of this that the alternative to more and more narrowly prescriptive regulation is structural reform. I'm a great believer in that, but I've had my confidence shaken a bit recently. Partly as a result of a slightly woozy conversation with the senior banking lawyer at a big law firm in London. As far as structural reform is concerned, I now feel that there are basically two options. Lots more banks, which is my preference, or far fewer banks, which is his. Neither of these alternatives is likely, but they are possible. And they are goals to which we could aspire if we were so minded. And I do think it's important for bankers, regulators, and for politicians to have some vision in their mind beyond the day-to-day pressures of making a buck, or making a naira, or making several thousand naira, or making several billion naira, or making sure a bank doesn't go bust. But these options, these two options that I've laid out, are very, very different. The argument for fewer banks is deceptively simple. Unfortunately, it has quite a lot of support in the US and Europe. Basically, history tells us that banks go broke because they're predominantly national. And when something goes wrong in their home country, their access to liquidity dries up. I guess that particularly resonates in Nigeria. Their home country regulator then has three choices. Bail them out, as was done in the US, for instance, with Citigroup, nationalize them, as we did with RBS in the UK, or let them go broke, as with Lehman Brothers. If, on the other hand, banks were not national, but instead floated above individual national markets, rather like a sort of private sector NGO, what might happen in any particular country would not necessarily affect the individuals of banks' ability to raise liquidity elsewhere. Country A goes broke, it can raise money in country B. And thanks to their essentially global diversification, banks will be far less vulnerable to this kind of chain collapse that happened in the US savings and loan industry in the late 70s and 80s. This is a very seductive argument, but I hate it. What it suggests is that the model for the bank of the future should be the global accounting firms, the so-called Final Four, PwC, Ernst & Young, Deloitte, and Accenture, who between them audit about 98% of major listed companies throughout the world. No one really knows whether PwC is US or British or where Deloitte hails from. They're international networks of supranational partnerships which have no national base, no home country. And by and large, it's true they do a fairly decent job. Arguably, there isn't much in the way of price competition, and they don't exactly push the envelope in terms of accounting breakthroughs, but the system works. And that's also the way the legal profession is heading. What it will probably mean for us in finance is if this new shiny world were to materialize, there'll be a dozen or so huge global banks sucking up depositor funds from around the world, making loans, creating derivative products, managing assets, financing trade on both a national and a cross-border basis. Each of them too big to fail, and each of them most unlikely to fail because none would actually be vulnerable to the kind of disasters that have brought banks down in the past. Insofar as they were regulated, they would have to be regulated, presumably by the Basel Committee or by some sort of similar international or intergovernmental organization. Below them, of course, there might well be local affiliates of those networks, just as happens in accounting today. And below them, there will be tiny local institutions, perhaps like microfinance institutions. But banking, as we know it, will be inherently cross-border, benefiting from the alleged economies of scale that exist in retail and commercial banking. Now, at a certain level, that sounds appealing, but personally, I find it an appalling idea. Effectively, it would freeze innovation in finance and would convert banks into bureaucracies. So let's just look at the other alternative for structural reform, the one that I've been promoting for a couple of years so far with absolutely no success. What I would like to see is the restructuring of the industry to reduce, perhaps even to eliminate, the crushing regulatory burden that it faces today. I want to make banking a normal industry, like, for instance, hairdressers or travel agents. A normal industry that will be regulated only for fraud. I want to slash regulation and reimpose the power of the markets. Now, how might one go about this admittedly quixotic task? First, I think you liberate the power of technology. My little think tank published a report a few months ago on non-bank alternatives for small and medium enterprise finance. The author of that report found 48 internet-based platforms in the United Kingdom for equity finance, bond funds, factoring, various forms of asset-backed finance, all of which disintermediate banks. Add to that peer-to-peer lenders. I don't know if you have them here, but we have Zopa growing very fast in the UK. And we have one of the fastest growing sectors of the UK economy, one which is based on the agreement of consenting adults, and which has the potential to be a game changer for financial services all over the world. That needs encouraging. It doesn't need strangling at birth by imposing on it the full weight of financial regulation that's been developed for the conventional banking sector. Not least because these are platforms. These are brokers, if you like. They're not principals in the deals that they put together. They don't hold client money. Now, I don't know how relevant that is yet in Nigeria, but my guess is that it is precisely the kind of business that over the years Nigerians have been good at. For God's sake, we're all traders. Too good, perhaps sometimes in the past. And I must acknowledge that what works in the UK on an almost unregulated basis might need a bit more oversight over here. But I think it's worth looking. Second, I would like to revive the idea of partnerships, particularly in the investment banking area. In the old days, investment banks were almost exclusive partnerships. It was a feast and famine business. In good years, partners made out like bandits. Actually, some of them were. In bad years, they often ended up kiting the salary checks, but they had their own skin in the game. And that's completely different from relying on investors, or worse, relying on the government. It's also, I think, for the most part, how today's hedge fund industry works. And even though I might despise the returns that hedge funds make, I think we can learn a lot from the ownership structure. Same with private equity. Yes, it can be damaging to society, but it's not the ownership structure of private equity that's wrong. It's the preferential treatment in the UK and the US for tax purposes of debt over equity. Put debt on an equal footing with equity, and the private equity model is one to emulate. So give investment banks a choice: heavy-handed regulation if they are, as most are today, public companies, or essentially no regulation except for fraud if they're partnerships, and see which way they go. Those two proposals strip out much of what the multi-purpose bank of today does, but that still leaves us with a core bank. What would I do with that? Well, as I say, I want to make it like a normal industry. I concede that in Nigeria, the travel agency business might not be quite as good a model as in the UK or the US. We may have to find a different model here, but bear with me. In the UK, at least, the travel agency business is an industry which is characterized by cutthroat competition, by enormous platform flexibility, physical, virtual, whatever, very low exit and entry barriers, minimal regulation, essentially only conduct of business, and virtually no day-to-day supervision. And most important, private or industry mutual insurance protection for clients and customers, which protects them from the problems of the industry. In the UK, this is divided into something called ATOL. The last of these is crucial. Anyone like me who advocates radical structural reform of our financial system is immediately attacked by those who argue that customers will just be ripped off. That's, after all, why we have publicly funded deposit protection schemes. And if taxpayers' funds are at risk, and undoubtedly they are, there's an obvious case for more and more intrusive regulation. Well, that, of course, in my opinion, is nonsense. We could just as well insist, for instance, that any bank or corner store or market trader can take customer deposits, but that those deposits must be insured with a pool of, say, AA-rated private insurers according to some kind of template which will be worked out by the government and the industry. That might be trickier in Nigeria than it would be in the UK, but I imagine that you have a thriving insurance industry, certainly used to, and it ought not to be impossible. Developing that template that would underpin those deposits is a legitimate role for regulators. Micro supervision of day-to-day activities is not. Now, so long as depositors are protected and a lot less bothered by the lending side, if banks are imprudent in their lending, a combination of insurers and investors is likely to pick up the lives much more quickly than some smarty-pants regulator. But I'd be perfectly happy to consider other smart forms of regulation. For instance, mandatory subordinated debt issues, as has been suggested in the US, to ensure there's a sort of real-time marker for an institution's creditworthiness. What I don't want is more and more dumb regulation designed to keep banking special and regulators in a job. Unfortunately, that's what we're getting, certainly in the US and in Europe. And that's the message that I want to get across to you today. In my opinion, some very clever people around the world, some of whom I know well, and who are generally well-meaning, are making some enormously important errors. Errors that, in my opinion, will cost us all. By insisting on increasingly prescriptive micro and macro-prudential supervision to a global standard of more and more banks, they're in danger of killing the golden goose, the goose that has given us 50 years of pretty solid economic growth around the world.
Your Excellency, distinguished guests, ladies and gentlemen, will agree with me that that was indeed an inspiring, intelligent, educative, informative presentation by our guest speaker. And so one more time, let's make it loud for him. Let's appreciate our own Dr. Andrew Omuwale Beauty. Congratulations. Thank you. Thank you very much. Excellency, distinguished guests, we are gradually running to the end of this program. Please permit me to quickly make this announcement. Okay, what did they say? What answer did you get? Something must change, like Omawale has told us. A round of applause for ourselves. And so on this note, I one more time like to invite the first Vice President to do something very special here today.
Before I actually release the result, I'm sure we have some comments, some questions, and that we need some answers to. So I'm going to hand over to the President to please chair that session. Thank you.
Imagine liberalized banking, target regulation, everybody can just money, want to talk about insurance, and the need for non-insurance grade. But again, this is a very people. I mean, many changes that have changed the world have come from very radical conversations. I'm sure everybody will look at it. But the state we are in now, because it's too much, we are going to spend more time trying to summarize the paper, but just to ask from the audience, you know, your comments and questions. Please make it short. Stand up, mention your name and what you do, and then just make your comments or ask your question very, very shortly.
Thank you for thank you very much, Dr. Hilton. The paper has been very, very instructive. Not only informative, but very instructive. Unfortunately, as you expect in this kind of environment, all these eggheads, disagree with your conclusion. And you permitted me to take it in properly because you brought it at the end. You said the problem with banking is intrusive regulation, over-regulation. And it's unfortunate that this is the view held by not only regulators, but also politicians, and by the ordinary men and women of the industry in the world. Nobody talks about lending. You said you even said it. I don't care what they do with the person, what they get it. The problem with banking, from the way I see it, is lending. No bank has been killed by regulation. No. Banks have died. They have tried because they lent well, and they have died because they didn't lend well. You send money out, you know it doesn't come back. That is it. And that is why we don't care about training. We don't train people to know how to lend. You can't make an MBA graduate from whatever university come into the bank and then he starts lending without learning. That is the problem. You don't learn by spreadsheets. No. Bank lending is the basic thing in banking. That is why those who are in banking today and are doing well, that's why they are doing well. Not because of derivatives, not because of deposit. You take the deposit, you throw it out if you don't lend it well. And our economies are not growing because people are making money from businesses other than lending. That's what we are not investigating. The other issue I would like you to clarify is what is the position of the Chartered Institute of Bankers today in relation to the new university system and the university they have. My journals that come to me still tell me that there is an institute of bankers that is still existing. Right? And probably is the owner of all these babies that are being created. And therefore, there's still the relevance, there's still a place of relevance for the Chartered Institute of Bankers anywhere in the world. Thank you.
Without learning, yes, of course. You're absolutely right. But of course, it goes back even one stage beyond that. What you've got to have is good companies to lend to. It's much easier to lend in a thriving economy where there's relatively high growth, where there are lots of private sector companies, where there is a rule of law, where there is the opportunity to make a buck legitimately. So yes, obviously, it helps for bankers to learn. I don't dispute the idea of bankers training, and I note the key role that Chartered Institute bankers of Nigeria plays. But one stage back, there's got to be companies to lend to. If you don't have the companies to lend to, what do you do with the money? You lend it to the government. And frankly, you can lend it to the government to be on the golf course by 4 o'clock. It's easy. What's difficult is finding companies which are good companies, that are growing companies, and that need money to lend. The second point, the Chartered Institute of Bankers, I'm assuming you're talking about here what's going on in the UK.
Yes.
Right, in the UK, the Chartered Institute of Bankers, which is a very, very old and very wonderful name, has been changed initially to the Institute of Financial Services, then to IFS School of Finance, and now to IFS University. IFS, the old Chartered Institute of Bankers, is now a degree-giving institution. Whether this is the right thing to do or not, I am not the one to say. The director of it is a good friend of mine, Gavin Shreve, and he is very adamant. He's worked very hard. He does not consider the IFS to be a training institution. In fact, he has taken considerable pains to attack the government for saying that it is a training institution. He says it is a university. It is a degree-giving institution. It gives education and not training. He makes a distinction between education and training. However, you've mentioned the Chartered Banker Institute, which is the Scottish equivalent to the old Chartered Institute of Bankers, which is now the only Chartered Banker Institute in Britain. And it is trying to move into the space that was left by the demise of the old Chartered Institute of Bankers. So there may well be a training institution. It's called the Chartered Banker Institute in London. There are also many, many training institutions, public and private, that train bankers and regulators and compliance officers. So there's not a shortage of training in the UK anyway. I don't know if there is here.
Well, I want to look at banking, makeover banking in Nigeria. Just want to make some comments. I look at banking in Nigeria today and I say to myself, are we really doing banking? Now, I said this because I think that banking as we know it is not happening again in this country. There's very little financial intermediation, I stand to be corrected, going on now in this country. I think that we are overly concerned about protection, overly protective. The regulator is overly concerned about the rates of cost of credit, level of interest rates. And so you talk about makeover within the context of Nigeria, and say to yourself, where is it going to place in life? Where is it going to land? And
on the board, probably they go to bed, or the controls are not probably taken serious. 2, the regulators are not doing enough. They are not really proactive. You allow problems to happen before you tackle them. We have banking crisis in the 60s, in the 70s, in the 80s, in the 90s. What have we learned from these issues generated? And banking essentially is about risk management. The risk infrastructure is not actually designed for financial intimidation and control purposes. Those are things we should, and the disparity between deposit rates and the lending rates gives one a nightmare. Deposit rate about 2% of the savings, while lending goes for 24, 26%. Need to work towards.
Thank you very much indeed. Last question, I have to take a lady, Mrs. Yoshidero. That's the last question. Please, if you have any comment to make. Luckily, Dr. A.T. will be making a breakfast presentation tomorrow at the Center for Financial Studies at 8:30.
We've heard about banking makeover. What will change? What do we expect that will change? At least one thing in Nigeria. I feel the regulators should change their ways. They also need training so that they will know what they are regulating. Over-regulation is lack of training. Under-regulation is lack of training. Before they put them there, or when they put them there, let them be trained. Let them continually be trained so that they will know how to regulate and what to regulate. Banking is not what it used to be. As I said, we are not doing banking. I don't know what we are doing, but we are not doing banking. Even from, as you enter the banking, the banks, the branches, from the cashier, many of them are not experienced enough, not trained enough to know what they are doing. I feel like regulators should not wait until we have a banking crisis before they come to train. They should be trained. Training as we learn. We all learn every day. Thank you.
Thank you very much. There are
center of the study of financial innovation, because innovation was a good word and we wanted to encourage financial innovation. Since then, of course, financial innovation has become a bad word. As Paul Volcker famously said, the only innovation that, in his opinion, had ever added to the sum of human happiness was the ATM machine. And we have discovered that certainly over the last 15 years, we have ceased to be the Center for the Study of Financial Innovation, and we've become the Center for the Study of Financial Regulation. The entire financial industry dances to the tune of the regulators, and too much time is spent, in my opinion, trying either to follow the regulations, which are both national and international, or to circumvent the regulations, be they national or international, which means hiring more and more lawyers to circumvent them, more and more compliance officers to follow them. And that's not very productive. What banks need to do is find good projects to lend. They need to encourage those projects to grow. Yes, obviously you've got to have an economy which produces those small-scale businesses that become the large-scale businesses of tomorrow. But banks ought to be in the business of lending and not in the business of financial engineering or in the business of circumventing regulations.
Thank you very much for those comments and questions. Thank you for the review.
Thank you very much. Another round of applause for ourselves. Thank you.
Thank you very much, Aki. And thank you very much, the President and Chairman of Council, for anchoring the question and answer session. Well, to mark the 50th anniversary, we also got in some students of the banking and finance of tertiary institutions to write essay. It was a competition, and at the end of it was published in the papers, and at the end of the day we had 98 entries. Out of the 98, 13 were invited, were shortlisted, and were invited to for an interview. And out of the 13, we came up with 8 winners. 3 of them are here today, the first, second, and third, but the 4th, 5th to 8th had been given their prizes during the interview session. So the second runner-up, the prize will be given by Professor Wale Adeumi, and I'm going to ask him to please come forward. The winner is Mr. Ebere Ume Kalu. He's a student, he's unemployed, and his prize is a cash prize of 100,000 plus a tablet phone. Mr. Ebere Kalu, please could you come forward?
Mr. Khan, I'd like to congratulate you for this excellent performance. You're one of the best 3. All of these 3 countries means a lot. It is unfortunate that our bankers, our managing directors, our executive directors who will give fellowship to are not here. They should have given this board a job right in much for our fellowship to them. I hope the Institute will send this boy out to those guys, say that he's a guide of the future of this industry tomorrow. And therefore, they should please help us. Examine him, test him, interview him, and give him a job. Thank you very much.
Before we run off, to get ready, Mr. Oluwatosin Ogunleye is a student of the Department of Banking and Finance, University of Lagos, Akoka, and the prize will be given by Chief Okafor, a past president of the institute. 1,000 plus a laptop.
Oluwatosin Ogunleye, I have to congratulate you indeed on your very solid performance in the examinations. This is a competition, yes. It shows what will become in the future. And all I can say to you is you have to try to keep it up. Whatever you find yourself, whatever endeavor you find yourself in life, the same attitude you apply to this, you can apply to that. I'm grateful to find somebody like you, and this is presenting to you this technique. To show our decision, we have determination to succeed.
Hold it and face it. Yeah. Turn it. Let's see. Turn it, Saturday. Okay. Okay. Thank you. Thank you.
So the winner for the 50th anniversary essay writing competition award goes to Mr. Adedej Isaac Alonge. He works with First Bank of Nigeria, ET Print Ground, Bida, and that prize will be handed over to you by the President and Chairman of Council, Mr. Shegun. So
Isaac Alonge Adedej, I congratulate you on this very big award, the anniversary essay competition, and I want to enjoy you to continue to give it up. You aim for excellence in anything you do, and I can assure you that the future is very bright. Congratulations.
Thank you very much, President and Chairman of Council. We know that our guest speaker, our guest of honor for today, His Excellency, has to leave before 5. We promised that we will leave here before 5. So, as a token of your being here, I'm sure the President has something to present to you. Thank you.
Thank you, for being here. I know we were last night, out of 2 hours. I know we've done 3 hours.